Juan is so excited he's entering high school. He's going to take a dual credit accounting class, meaning he will receive credit toward high school graduation and college hours. Juan meets with his counselor to finalize the schedule, and she asks him if he wants to take financial or managerial accounting. "What's the difference?" he asks. The counselor tells him to speak with Mr. Wade, the accounting teacher, then come back and select the class. Juan finds Mr. Wade in the teacher's lounge and explains his conversation with the counselor. Mr. Wade says he would be happy to explain the differences. He tells Juan managerial accounting provides executives and managers with financial data to make internal business decisions. Managerial accounting reports can be created in any format based on the end user's request, whereas financial accounting provides information about the company's financial health to help the external users to make decisions. Financial accounting creates verified and reliable information based on a set of guided principles. Mr. Wade asks Juan to follow him to the classroom so he can provide further explanation. The first standardization accountants follow in financial accounting is to use double entry bookkeeping. Double entry bookkeeping is a system whereby each transaction creates two, or double, entries. For example, if a business pays $1,000 in cash for rent, the accountant adds $1,000 to a rent account and subtracts $1,000 from the cash account. Accountants enter those entries on what we call T accounts. There is a T account for rent and one for cash. On the left side of the T account are debit entries, and on the right side of the T account are credit entries. Some accounts increase with a debit, while some decrease with a credit, and vice versa. Mr. Wade points to a poster on his classroom wall that shows the acronym GAAP, or GAAP. He asks Juan if he knows what the acronym represents. GAAP refers to Generally Accepted Accounting Principles, which are standards publicly traded companies must follow to report financial data. The Financial Accounting Standards Board, or FASB, established GAAP and makes continual revisions. FASB is a nonprofit organization comprised of 7 main board members. They, along with their staff, establishes standards and reporting to increase confidence in the financials of companies for lenders, investors, and other external users. Companies are categorized as privately or publicly owned. Privately held companies seek financing through loans, donations, and private investments when they want to expand and grow. They do not necessarily follow a set of standards in reporting. However, companies who seek financing from the public are required to follow GAAP to provide a level of confidence in the reported information. When a company has maximized their ability to borrow money and seek private investments, they turn to the public by offering stock. Stock represents a portion of company ownership. Investors purchase stock with cash, and the company uses the cash for expansion and growth initiatives. To ensure investor confidence and protection in trading stock, the Securities and Exchange Commission, or SEC, regulates the purchase and sale of stocks. While the SEC ensures laws are enforced, they do not guarantee profitable investments. Mr. Wade asks Juan if he knows why these principles are important to external users. Juan says external users include lenders, investors, and suppliers. They rely on the financial accounting reports to make important decisions on loaning money or investing in the company. Mr. Wade explains that after consolidating all the transactions based on GAAP, the transactions are created into 4 main financial statements: balance sheet, income statement, the statement of cash flow, and statement of owner's equity. These statements are also called financial accounting statements. The balance sheet shows the company's worth, while the income statement shows profit. The statement of cash flow provides a solid picture of how the company reports cash, incoming and outgoing. Lastly, the statement of owner's equity shows changes in the owner's investment. Financial accounting differs from managerial accounting. Financial accounting provides external users with information to make important decisions. If the company is publicly held, they must follow GAAP, or Standards in Reporting Financial Data. The FASB also provides another level of protection and confidence for investors. The Securities and Exchange Commission enforces the purchase and sale of stocks. Based on the guidelines from GAAP and the SEC, companies construct financial statements to help external users make informed decisions.
There is ebb and a flow to every industry. In accounting, the ebb and flow is the accounting cycle. The term accounting cycle refers to the specific steps that are involved in completing the accounting process. The cycle is like a circle. It begins at one point and revolves through specific steps before starting again at the same point, and then repeating those same steps. The length of the accounting cycle varies from company to company. It may be monthly, quarterly, semi-annually, or annually, depending on when the financial statements of the company are published. Regardless of the timing of the accounting cycle, the processes involved remain the same. There are 10 basic steps to the accounting cycle. 1. Collect source documents. The very first step in the accounting cycle is to gather all the documents that are related to financial transactions of the organization. These documents, called source documents, are things like receipts, bank statements, checks, and purchase orders. They're the items that describe what a transaction was for. 2. Analyze transactions. The second step in the accounting cycle is to analyze the source documents. The purpose of this is to look them over and then decide what effect they have had on company accounts. 3. Journalize transactions. The third step in the accounting cycle is to post entries into the journal for the analyzed transactions. A journal is the book or electronic record that documents all the financial transactions for a company and the accounts that are affected by each transaction. When a journal entry is made, the double entry rule is used. This means that for every one transaction, at least 2 accounts are affected. There must be a debit and a credit for each transaction, and the total of debits and credits must equal the amount of the transaction. Journal entries are entered in chronological order, and debits are entered before credits. 4. Post transactions. The fourth step in the accounting cycle is to transfer information from the journal to the ledger. A ledger is a book or an electronic record of all the accounts that a company has. These accounts are broken down by account, number, and class. When the information from the journal is transferred to the ledger, it is transferred to each account that was affected by a transaction. 5. Prepare an unadjusted trial balance. A trial balance is a list of all the company's accounts and their balance at the time the trial balance is prepared. An unadjusted trial balance is a trial balance that is prepared before adjusting entries are made into accounts. This information comes directly from the ledger. The total debit balance and total credit balance must be equal. 6. Prepare adjusting entries. Adjusting entries are entries that are made in the journal and posted in the ledger. The purpose of these entries is to bring account balances to the proper amounts. Not all accounts will have an adjusting entry. Adjusting entries are made at the end of the accounting period, but not the end of the accounting cycle. 7. Prepare trial balance. Remember, the trial balance is a list of all accounts and their balances after adjustments have been made. This trial balance is prepared to check and make sure that debits and credits equal after adjusting entries are made. It is used to prepare the financial statements. 8. Prepare financial statements. These are prepared in a specific order because information from one financial statement is often used in preparing another financial statement. The order that the financial statements need to be prepared is: income statement. This statement measures how well a company is performing financially during a specific time period. If the company made money, then it had a net profit. If it lost money, then it had a net loss. Statement of retained earnings. This statement shows the effect of any profit or loss on the retained earnings of a company for a specific time period. Balance sheet. This statement summarizes the assets, liabilities, and stockholders' equity of an organization at a given time. Asset accounts are always listed on the left side of the balance sheet, with liabilities and stockholders' equity on the right side. The balance sheet must follow the basic accounting equation formula of assets equals liabilities plus stockholders' equity, meaning that the total balance from all accounts on the left side of the balance sheet must equal the total balance from all the accounts on the right side of the balance sheet. Statement of cash flow. This statement shows how much money is made and spent by a company during a given time period. 9. Prepare closing entries. Closing entries are the entries that are completed after the financial statements have been prepared. The purpose of these entries is to close out temporary items by transferring income and expense items to the balance sheet. 10. post-closing trial balance. The last step in the accounting cycle is to prepare a post-closing trial balance. The post-closing trial balance should only contain the permanent accounts that are used in the company and their balances. All temporary accounts should have been taken care of with the closing entries. Again, the total balance of all debit accounts must equal the total balance of all credit accounts. Once all 10 steps of the accounting cycle are complete, it is time to begin a new accounting period. The accounting cycle is a multi-step, complex process. Each step must be completed successfully in order to complete the step that follows it. By having the multiple steps that it does, there is a greater chance of catching errors long before the accounting period is closed. Since the financial statements paint the picture of the financial health for a company, it is very important that all information contained in those statements be accurate. For that reason, it is imperative that anyone working in the accounting field pay close attention to the work that they are doing. Even transposing one number can cause hours of headache for the person trying to balance the books.
Have you ever forgotten to record a check in your checking account register? I sure have. It wasn't a huge mistake on my part, but can you imagine what it would be for a business? Not recording something in the right place could significantly affect the financial statements for the business. That's why it's so important to record each and every business transaction that occurs in a business. I'm sure that you already know what a transaction is, but even so, let me refresh you on the concept. A transaction is an event that occurs in a business that changes the balance of at least 2 accounts. Why do I say at least 2 accounts? I say that simply because the accounting system that is used by accounting professionals is called double entry accounting. Double entry accounting states that for every one transaction that occurs, there will be at least 2 accounts affected. One account will be debited and one account will be credited. A debit is an entry made on the left side of an account. A credit is an entry made on the right side of an account. These dual effects of a single transaction will either increase or decrease an account balance. That depends on the type of account that it is. Looking at the charts, you see that asset and expense accounts have balance increases when they are debited and balance decreases when they are credited. In direct contrast, liability, stockholders' equity, and revenue accounts have balance decreases when they are debited and balance increases when they are credited. These are very important points to know when recording transactions. Recording business transactions is a multi-step process. The first step in recording business transactions is to examine the transaction and decide what accounts will be affected. The second step in recording business transactions is to decide what account will be debited and what account will be credited. The third step in recording business transactions is to actually document the transaction in a journal. A journal, which is also known as a book of original entry, is the first place that a transaction is written in accounting records. Even when you're using a computerized accounting program, items are still recorded in journals. You just don't manually enter them. The best way to learn how to record business transactions is to actually record some. So let's look at a few examples. Alex owns a music shop. On August 1st, he purchases drum heads from Drummers R Us to sell in his store. He pays $875 in cash for the drum heads. In his first transaction, Alex bought drum heads, which is inventory for his store. He paid for the drum heads with cash. The 2 accounts that will be affected are cash and inventory. For Alex's music shop, the inventory account, which is an asset, is debited to $875. This increases the balance in the inventory account by the same amount. Because Alex paid with cash, the cash account will be credited $875. A credit made to an asset account decreases the balance in the account, so the cash account will have an $875 reduction in its balance. After you decide what accounts are affected by each transaction, you can record or journalize the transaction. To do this, you'll make an entry into the journal. You start by listing the date, followed by the name of the account that is debited, and the debit amount on the first line. On the next line, indented slightly, you will put the name of the account that is credited, followed by the credit amount. On August 6th, Alex sold all the drum heads to the local high school band for a total of $1,500 cash. In this case, what two accounts are affected? Well, because this is a cash sale, the same two accounts are affected that were affected when Alex purchased the drum heads. The difference is that they will be affected differently. The cash account will be debited $1,500 and will have a balance increase in the same amount. The inventory account will be credited and will have a balance decrease in the same amount. On August 10th, Alex has to pay his monthly rent on the building that his music shop is in. He writes a check to Thomas Realty in the amount of $1,000. In this transaction, the accounts that are affected are rent expense and cash. The rent expense account is debited $1,000. Since expense account balances are increased by debits, this increases the balance in the rent expense account by $1,000. The cash account is credited $1,000. Since cash is an asset account and is credited, the balance in the cash account decreases by $1,000. On August 12th, Alex orders more supplies for his shop from Music Central. This time he buys his supplies on account. The total amount of musical equipment that he buys from Music Central is $4,500. In this transaction, the accounts that are affected are inventory and accounts payable. The inventory account is debited $4,500, which increases the balance. The accounts payable is credited $4,500. Because accounts payable is a liability account, a credit to a liability account increases its account balance. The balance in account payables increases $4,500 for this transaction. On August 13th, Alex sells a trumpet to a customer on account. The total price of the sale is $985. In this transaction, the accounts receivable and inventory accounts are affected. Since the sale was made on account, the accounts receivable account is debited $985. A debit to an asset account increases its balance, so the balance in the accounts receivable account is increased by $985. The inventory account is credited $985. The credit to an asset account decreases its balance, so the inventory account balance is decreased $985. As you can see, not only did every transaction affect two accounts, it also affected them in the exact same amount. That's another important concept of the double entry accounting system to remember. The total debits must equal the total credits. Ensuring that they are equal keeps the balance in accounts. A transaction is an event that occurs in a business that changes the balance of at least two accounts. The reason that transactions must affect at least two accounts is because accounting professionals use a system of accounting called double entry accounting. Double entry accounting states that for every one transaction that occurs in a business, at least two accounts will be affected. One account is debited, one is credited. A debit is an entry on the left side of an account, where a credit is an entry on the right side of an account. Whether an account is increased or decreased as a result of a debit or credit depends on what kind of account that is. Asset and expense accounts are increased by debits and decreased by credits, while liability, owner's equity, and revenue accounts are increased by credits and decreased by debits. Regardless of the type of account that is being used, the amount debited and the amount credited in each transaction must be equal. This ensures accounting professionals that they are keeping the balance, which is what accounting is all about.
Double entry accounting is based on the accounting equation that was developed around 1494 by Luca Pacioli. Luca Pacioli was a Franciscan friar who was a friend and collaborator of Leonardo da Vinci. Pacioli's equation is profound in its simplicity. Assets equals liabilities plus equity. Double entry accounting puts this equation to use by making sure that every financial transaction is recorded with an entry that utilizes at least two accounts and where the total amount of money on the left, the debit side, equals the total amount of money on the right, the credit side. This is where students taking their first accounting course often get confused. Thanks to the banking industry's use of the terms, we tend to think of a debit as being like our debit cards that take money out of our accounts and a credit as being like our credit cards that create a liability on our part. In accounting, Debit and credit are nothing more than directional indicators, meaning left and right. We could use them in well-known situations as nothing more than directional indicators, and it would make perfect sense to anyone who understands their use in accounting. A drill sergeant could as easily call cadence when marching by shouting debit, credit, debit, credit, debit. In the movie Every Which Way But Loose, Clint Eastwood's famous tagline could have been, "Credit turn, Clyde." So now we know that debit is left and credit is right, but left and right of what? The answer is the left and right columns of a standard 2-column journal. The journal and the ledger are the two basic volumes that control a company's books. A journal is a record of the various financial transactions that happen in the course of business. Entries are initially made to the journal and then posted, or copied, to the ledger, which tracks the effects of those transactions on individual accounts. An individual account is a group of similar items, such as cash, office equipment, accounts payable, or common stock. This is a picture of part of a general journal page with a couple of entries to illustrate the concept. Notice that each entry has the date the transaction happened, what accounts were affected, how much money was involved, and a short description of what happened. Notice too that both the debit and credit columns contain the same total amount of money for each entry. It is important to remember that they need to contain the same total amount. As many accounts as are needed may be used on each side, and any appropriate dollar amounts may be entered. The entry below is just as valid as either entry above. A journal entry that uses more than 2 accounts is called a compound entry. Notice in this example that the entry uses 6 accounts. 4 are debited and 2 are credited. The entry still meets the requirement that the total dollar amount is the same on each side. Debits, $4,000 plus $1,500 plus $8,000 plus $2,000 equals $15,500. Credits, $10,000 plus $5,500 equals $15,500. You may have noticed the column labeled Post Ref, which stands for Posting Reference. This column is used to indicate the page in the general ledger to which that line of the transaction was posted. By keeping the dollar amounts on each side equal, we ensure that we will also maintain the accounting equation, and assets will indeed equal liabilities plus equity. As noted, each line of a journal entry is posted to the appropriate account of the general ledger. For example, our first journal page illustration included a $10,000 debit to cash on April 1 and a $225 credit to cash on April 2. The general ledger page for the cash account is shown with these items posted. The 1 in the post-ref column tells us that each of these items came from page 1 of the general journal. Notice that the balance columns don't just copy the amounts transferred from the journal. Instead, the amounts in the column with the smaller total are subtracted from the amounts in the column with the larger total, and the result is entered into the larger column. 10,000 debits minus 0 credits equals 10,000 debits in the first entry, and 10,000 debits minus 225 credits equals 9,775 debit in the second entry. Accounts are said to have either debit or credit balances depending on which side has the most money entered. Different types of accounts also have different normal balances. Using the word normal in association with accounting may seem like an oxymoron, but we do say that certain types of accounts have either a debit or credit normal balance. This means that they tend to have balances that are either on the debit or credit side most of the time. In studying accounting, we notice that 2 types of accounts, assets and expenses, tend to carry debit balances. The other 3 common types of accounts tend to carry credit balances, which are liabilities, equity, and revenues. We can think of entries to the normal balance side of an account as adding to the account, and entries to the other side as subtracting from the account. We saw this with the cash account earlier while looking at the general ledger. An easy way to remember the normal balances of the asset, liability, and equity accounts is to simply remember the accounting equation. Assets equals liabilities plus equity. Notice that assets are on the left, or the debit side of the equation, and as we noted earlier, assets have a normal debit balance. Liabilities and equity are both on the right, or the credit side of the equation, and both carry a normal credit balance. This fails to cover revenues and expenses, but we also have a way to remember their normal balances. The revenues earned and expenses incurred by a business are where the company's income comes from. The income of the company belongs to the owners. Therefore, we can think of revenues as adding to equity and expenses as subtracting from equity. Equity has a normal credit balance, so credits add and debits subtract, and so we can remember that revenues, which add to equity, have a normal credit balance, just like equity. Expenses, which subtract from equity, have a debit normal balance from equity. Double entry accounting is an accounting system that involves the recording of all financial transactions in at least two accounts. Within the accounts, the total entries on each side, the debit side and credit side, must be equal. The debit side is the left side, the credit side is the right side. Certain accounts tend to carry normal debit balances like assets and expense accounts, while others tend to carry normal credit balances such as liabilities, equity, and revenues accounts. This system is based on the equation developed centuries ago by Luca Pacioli. Assets equals liabilities plus equity. While this concept has been around for many years, it still finds use in the accounting field.
In accounting, transactions affect account balances on a daily basis. When account balances change, so does the overall financial status of an organization. People like investors, creditors, company executives, and employees, they're all very much interested in the financial status of a company. So because of that, the concept of periodic reporting was created. Periodic reporting means that company finances are reported in distinct time periods. Now, the time period principle goes hand in hand with periodic reporting. This principle is one of the major accounting principles that were created by the Financial Accounting Standards Board, which is also known as the FASB. The FASB is the governing board of accounting practices in the United States. The time period principle states that the activities of a business can be broken down into specific, short, and distinct time intervals. These intervals can be monthly, quarterly, semi-annually, or annually. It just depends on what the specific company feels is necessary to accurately show their financial status at specific points in time. Now, does it really matter when financial information is reported? Well, it actually does. Company leadership needs to see the financial reports of a business more than just once a year, simply because they have to forecast the future sales, expenses, and staffing of their company. Information that is reported on the financial statements allows them to do that forecasting as accurately as possible. For investors, creditors, and those that are potential investors and creditors, it lets them see how well the company is performing at different times, as well as comparing past and present performance records. This allows them to make informative decisions on whether they want to enter into or continue business relations with the company. Employees are interested in the financial status of the company for two very good reasons. First, employees may take part in profit sharing within a company. In that case, the better the company performs, the more money that employees are building in retirement accounts. Second, employees are interested in company finances because it can affect their job security. They need to know that the company is on track financially, or if it isn't, they need to prepare themselves for potential layoffs and shutdowns. Regardless of the reason for periodic reporting and the time period principle, they're both very important in the world of accounting. Periodic reporting and the time period principle go hand in hand. Periodic reporting means that company finances are reported in distinct time periods, while the time period principle means that the activities of a company can be broken down into specific, short, and distinct time periods. These time periods can be weekly, monthly, quarterly, semi-annually, or annually, whichever best suits a specific company and accurately portrays their financial status at specific points in time. The time period principle is one of the generally accepted accounting principles that have been established by the Financial Accounting Standards Board, the FASB. The FASB is the governing board of accounting practices in the United States. There are a number of individuals who use the data that's reported on the financial statements, such as company leaders, investors, creditors, and employees. Employers use the financial data to aid them in forecasting the future sales, expenses, and staffing needs of their company. Investors and creditors want to see how well a company is performing so they can decide whether to continue their current relationships or even enter into new relationships with the company. Now, employees may be interested in the financial data that's reported for a company when they're participants in profit-sharing plans, and the better the company does financially, the more their nest egg grows. A second reason employees may find financial data important is that it gives them an insight into how well a company is performing or not performing, which is important for job security. Reporting financial data in a timely and orderly fashion is not only a requirement of the FASB, but it's also a vital part of a company's livelihood. Casey just got home from school. For the first time ever, she's ready to start on her homework. Tonight, she gets to do a report on her favorite band, the financial statements. She can't wait to get to school tomorrow and tell everybody what the financial statements are, what they do, and why they are important. This is going to be the best homework she's ever done. Casey quickly sits down at the desk in her room and starts writing. Have you ever heard of the financial statements? No? Well, let me introduce them to you. The financial statements are a group of reports that tell a company's financial status at a certain point in time. From company owners to potential investors and everyone in between, the fan base of the financial statements is far and wide. Everybody is interested in them. Some people are interested in the financial statements because they want to know how much money they made. Some are interested in them because they want to know how much money they spent. Some are interested in them because they want to know how much money was reinvested in the company. Some just want to know whether or not they should invest themselves. Regardless of the reason, when the financial statements start playing a tune, people listen. Now it's time to introduce you to each one of the financial statements individually. Izzy is the lead singer of the group. His name, Izzy, is short for income statement. Izzy's job is to let fans know whether a company made or lost money in a given time period. Next is the bass player, SOAR, which is short for Statement of Retained Earnings. It is SOAR's job to let fans know how much money that's made is retained and reinvested in the company. The keyboard is played by Bash. Bash's real name is Balance Sheet. His job is to fill in all the gaps by listing all the assets, liabilities, and owner's equity. Bash is a key player in the group because he balances out the music. The asset side of Bash must equal the sum of the liabilities and owner's equity that Bash lists. An equation that is helpful in remembering what Bash does is assets equals liabilities plus owner's equity. The last member of the financial statements is the drummer, SoFly. SoFly, which is short for Statement of Cash Flows, is responsible for making sure that everyone knows how much money came into a company and how much went out. Izzy, SOAR, Bash, and SoFly all together make up one of the best bands in the accounting world, the financial statements. The financial statements are the #1 band in accounting today. Because of their popularity, they are influential to different groups of people. One group of people that is influenced by the financial statements are business owners. Business owners learn how much money they've made, spent, and retained from the financial statements. A second group of people that are influenced by the financial statements are investors. Investors can tell how much money they're earning or losing on investments in a business just by watching the financial statements. Still another group of people that are influenced by the financial statements are creditors. Creditors can tell how well a business is operating based on the performance given by the financial statements. The last groups of people that are influenced by the financial statements are a combination group of potential creditors and investors. This diverse group of people looks to the financial statements to advise them whether or not to enter into a financial relationship with the business. Wow, Casey thought to herself, it didn't take me long to get this report done. I better review it and make sure I covered everything I wanted. She picks up her paper and begins to read it. The first thing that she wrote about was what the financial statements were. The financial statements are a group of reports that tell a company's financial status at a certain point in time. The next things that she wrote about were who the group members were. There are 4 members of the group: Izzy, SOAR, Bash, and SoFly. Izzy is short for income statement. His role in the band is to tell whether or not a business made money. SOAR is short for Statement of Retained Earnings. His role is to let fans know how much, if any, money that was made was retained and reinvested in the business. Bash's job is to list all the assets, liabilities, and owner's equity of the business. SoFly is short for Statement of Cash Flows. His job is to let his fans know where money brought into a business came from and where money that went out of the business was spent. Looks good to me, Casey says out loud. Tomorrow I can tell my classmates all about the financial statements. The financial statements are the most popular band in all of accounting. Of the 4 members that make up the band, the income statement, known as Izzy, is the very first one. The income statement is the member of the financial statements that tells fans whether or not a company made a profit or incurred a loss in an accounting period. In everyday terms, the income statement tells whether a company made money or lost money in a certain amount of time. Easy is quite an interesting character and pretty easy to figure out. All you have to know are two simple things: revenues and expenses. If you know those two things, you can totally figure them out. All you have to do is use the simple formula: revenue minus expenses equals net income. Revenue is the money that a company takes in. Expenses are the money that a company pays out. Net income is the amount of money that is left after a company subtracts their expenses from their revenue. Everybody loves to see Izzy when he shows that a company had a net income, but what happens if it doesn't? If expenses are more than the revenue brought in, then the company had a net loss. Fans aren't that fond of a net loss because it means that the company didn't make any money. Now that you know what it is that makes Izzy who he is, let's take a look at what role he plays in the financial statements. The main thing that fans want to know from Izzy is the bottom line profit or loss that a business had in a certain time period. The numbers used to calculate that bottom line figure are cumulative, meaning that they are a total of all activities from the beginning of the chosen time period until the end of the chosen time period. Most income statements are generated on a quarterly or annual basis. Fans want Izzy to tell them whether a business is operating efficiently and would be a good credit or investment partner, or if it's not. Business owners depend on Izzy to tell them if the business is running efficiently or if there are areas that need improvement. Regardless of why fans are interested in Izzy, it's obvious that he carries a lot of weight as a member of the financial statements. Let's review what we've learned about Izzy. We learned that Izzy is the first member of the financial statements. The simplest way to figure him out is to use the formula revenue minus expenses equals net income. Revenue is the amount of money that a company brings in. Expenses are the amount of money that a company pays out. Net income occurs if the amount of revenue that came in was more than the amount of expenses that went out. Net loss occurs if the amount of expenses that were paid were more than the amount of revenue that came in. Potential creditors and investors depend on the income statement to tell them whether or not a business is a good financial partner. Business owners depend on the income statement to tell them how well the business is operating and whether or not there are areas that need to be reviewed. With all the responsibility that is placed on the income statement, Izzy has a very important role in the financial statements. This is Bash. He is a member of the financial statements, one of the most popular bands in all of accounting. Bash is quite the character indeed. He's always searching for equality in everything he does. Fans of the financial statements depend heavily on Bash to always give a solid performance whenever he is called upon. Since there is such an interest in Bash, I thought that we would take a little time to dive into his private life. We will look at what makes Bash who he is, what part he plays in the band, and how he ties it all together. Who is Bash really? Bash's given name is Balance Sheet. He is third out of 4 members of the financial statements. Each of the members of the financial statements has a specific role in the group. Bash's role is to keep the group balanced. He has a specific equation that he uses to accomplish this task. He calls it his motto. That equation is assets equals liabilities plus owner's equity. According to Bash, this equation is called the balance sheet equation, but others who've tried using it also call it the basic accounting equation. What do all the parts of the equation mean? Bash says that they're actually pretty simple. Assets are the things that he owns that have value to him. Liabilities are the things that he owes. Owner's equity is the amount of personal investment a person has in something. Does that make things clear to you? How about if I give you a few more examples? The financial statements are a band. So what are the things a band owns? How about musical equipment? Is that something a band owns? Of course it is. Well, if that's something a band owns, then it's an asset. But what else does a band own? What about their name? Since the band's name is the financial statements, and that name is their trademark, then it's also an asset. How about all the money that the band makes? Since they're so popular, I'm sure they make really good money. Yep, you guessed it, that money is an asset. Now that you know what assets are, let's take a look at liabilities. What are some things that the financial statements may owe? They travel to tour dates on a bus. They finance the bus with a local bank and are required to pay monthly payments on the bus. The payment on that bus is a liability. It takes gas to fuel the bus so that the band can travel to concert locations. The fuel for the bus, it's also a liability. The band also employs several assistants to help with hair, makeup, and clothing. The assistants are paid weekly. The pay is a liability for the financial statements. The third part of the balance sheet equation is the owner's equity. Bash said earlier that owner's equity is the amount of personal investment that a person has in something. What type of personal investment would he have had in the band? In order for the band to start up, each member had to come up with $2,500 to pull together and buy equipment. Each year, the group agrees to spend money on updating equipment. The initial investment made by Bash and the 25% of the cost of updating equipment is what can be counted as Bash's owner's equity. How does Bash make everything come together? He does that by using the balance sheet equation and listing not only what every account is, but also what its balance is. On one side of the balance sheet are the assets. On the other sides are the liabilities and the owner's equity. Everything in the group is divided into 3 sections. In the end, the total of all assets must equal the sum of the totals of the liabilities and owner's equity. If the 2 sides don't equal, then they're out of balance. That, according to Bash, is when you stop and reevaluate everything that makes you who you are. You examine every single piece of the puzzle until you find out what's out of balance, and then you fix it. Bash is thankful that even though it seems like a daunting task to undertake, he's able to rely heavily on his managers, GAAP, to guide him. GAAP, short for Generally Accepted Accounting Principles, are the standards by which members of the financial statements perform their roles. GAAP allows fans to know that things the members of the financial statements say are both reliable and comparable, and it allows them to decide whether or not they want to invest in the financial statement fan club. The story of Bash and his life have taught us several things about the balance sheet. First, we learned that the balance sheet is a part of the financial statements. The purpose of the balance sheet and the financial statements is to list all the assets, liabilities, and owner's equity accounts and their balances. Assets are what we own, liabilities are what we owe, owner's equity is how much of a personal investment an owner has placed in something that he owns. Generally Accepted Accounting Principles, or GAAP for short, are the standard by which items on the balance sheet must be reported. Assets are reported on the left side of the balance sheet, with liabilities and owner's equity reported on the right side of the balance sheet. In order to fulfill the properties of the balance sheet equation, the totals on both sides of the balance sheet must equal. There are distinct groups of people that rely on the balance sheet. Current and potential investors, as well as current and potential creditors, rely on the balance sheet to work closely with the other members of the financial statements to give them a performance that they can use to judge whether or not they want to join the fan base and invest themselves in the group. When it's all said and done, it's easy to see why without Bash, the financial statements just wouldn't be complete.
The financial statements are the most sought-after band in all of accounting. With just 4 members in the group, they each have specific purposes. In this lesson, we're going to take a look at the Statement of Cash Flows, SOFLI for short, who's the group member that is responsible for explaining any changes in the cash balance of a company during an accounting period. People interested in accounting and fans of the financial statements needed something that would help them understand exactly what causes net income to change for a company. Out of this need, SoFly became the fourth member of the financial statements. SoFly uses 3 specific types of activities to help him do his job. The first of those activities are called operating activities. These are the types of activities that occur during the normal day-to-day operations of a company. Each activity that occurs either affects cash coming into the company, called cash inflow, or cash leaving the company, called cash outflow. For example, when a fan purchases concert tickets to see the financial statements perform, that is a cash inflow for the group. When the band pays their security team for providing security at their concerts, that is a cash outflow. Both of these activities are operating activities because they occur during the normal operations of the band. The second type of activities that helps SoFly accomplish his job are investing activities. Investing activities are those accounting activities that involve buying or selling of long-term assets, as well as making or giving loans. Just as with operating activities, investing activities also have an effect on cash inflow and cash outflow. Let's look at some investing activities of the financial statement band as examples. The band decided that its current tour bus is just too small for them, so they decide to sell it. The band sells the bus for $10,000. The money received from the sale of the bus is a cash inflow. It falls under the investing activities section of the statement of cash flows because the bus is considered a business asset. Once the old tour bus has been sold, the band invests in a newer, more modern bus. The purchase of the new bus is a cash outflow. It is a cash outflow under the investing activities because the new bus is a business asset for the band. The third and final types of activities that help SoFly perform his job are financing activities. Financing activities are accounting activities that involve cash receipts or cash payments from changes on long-term liabilities. Falling right into line with the other 2 types of activities that are part of the statement of cash flows, financing activities also have an effect on cash inflow and cash outflow. The financial statement band has decided that it's time to branch out into further areas of business. They purchase a t-shirt shop that will make souvenir t-shirts that the band can sell at each concert. In order to purchase this shop, the band borrows money from the bank. The money borrowed from the bank is considered a cash inflow. This action is classified as financing activities because they involved the band incurring a bank loan, which is considered a notes payable in the accounting world. Now that you know what SoFly uses to assist him in performing his job with the band, let's look at why his job is important. Fans of the financial statements rely heavily on the group as a whole to paint a picture of how financially stable a company is. Each member of the band plays a specific role in painting that picture. The income statement and the statement of cash flow work closely together. Some say that SoFly is really just an extension of ISI, the income statement. Why would that be? Well, simply put, ISI is responsible for telling fans the net profit or loss of a company during a given accounting period. SoFly goes beyond that by explaining why changes in cash balances occurred. That is the first of 5 reasons that SoFly is important to fans of the financial statements. The second reason that SoFly is important to fans is because he helps them judge whether or not a company can pay the people that they owe money to. A third reason that SoFly is important to fans is because he helps them see whether or not a company has to borrow money to meet its debt obligations. A fourth reason that SoFly is important to fans is because he helps them see why there are any differences between a company's net income and the actual cash receipts and cash payments that a company made during a specific accounting period. Net income is the excess of cash that has been received after deducting cash that has been paid out. The last reason that SoFly is important to fans is because he helps them see why a company may experience changes in their financial position from one accounting period to the next. These changes typically occur if any operating, investing, or financing activities have taken place during that accounting period. Let's take a minute to review everything that you've learned about this unique character we call SoFly. The statement of cash flows is the last financial report required to be included in the financial statements. It is the financial statement that details the manner that cash came into a company and the manner that cash went out of a company. The cash that comes into a company is called cash inflow. The cash that is paid out on company liabilities is called cash outflow. The statement of cash flows is broken down into three sections: operating activities, investing activities, and financing activities. Operating activities are activities that occur during the normal day-to-day operations of a company. Investing activities are activities that involve the purchase and sale of long-term assets, as well as making or giving loans. Financing activities are activities that involve cash receipts or cash payments that are the result of changes in long-term liabilities. There are 5 main reasons that the statement of cash flows is important. First, it explains why changes in cash balances occurred. Next, it helps users judge whether or not a company can pay the people that they owe money to. Third, it helps them see whether or not a company needs to borrow money to meet its debt obligations. Fourth, it helps them see why there are any differences between a company's net income and the actual cash receipts and cash payments that a company made during a specific accounting period. The last reason the statement of cash flows is important is because it helps users see why a company may experience changes in their financial position from one accounting period to the next. As you can see, SoFly is really one important member of the financial statements because he deals with cold, hard cash.
Have you ever been to the circus and watched the high wire act? It amazes me how those men and women manage to walk across that little thin wire that stretched way above the ground. But what also amazes me is that the thing they use to keep them balanced is just a long pole. It's hard to believe, but did you know that an accountant and a tightrope walker have the same goal? It's true. They both work hard to keep something balanced. Where the tightrope walker uses the pole to maintain balance, the accountant uses a basic mathematical equation that's called the accounting equation. The accounting equation, which is written as assets equals liabilities plus owner's equity, shows the relationship between the 3 major types of accounts found in the accounting world. When used correctly, it's a reliable tool in maintaining balance in company accounts. In order to understand the accounting equation, you have to understand its 3 parts. First are the assets. Assets are anything that a company owns. Good examples of assets are cash, land, buildings, equipment, and supplies. Money that's owed to a company by its customers, which is known as accounts receivable, is also an asset. Liabilities are what a company owes. Things such as utility bills, land payments, employee salaries, and insurance, those are all examples of liabilities. The last component of the accounting equation is owner's equity. Owner's equity is the amount of money that a company owner has personally invested in the company. Initial startup cost of a company that comes from an owner's own pocket, that's a good example of owner's equity. Now that you understand the parts of the accounting equation, let's talk about how it works. Ed owns a small dairy. Production's been good these last few years, so Ed decided to open up a country store to sell some of his homemade dairy products. He borrows $25,000 from the bank to build the store. Once built, the store has a value of $40,000. Ed also has to hire an employee to help him work the store. The employee's salary is $15,000 a year. In order to make the cheese, the ice cream, and the sweet cream that he plans on selling in the store, Ed has to purchase equipment. He makes the $10,000 equipment purchase with money that he takes from his own savings account. So what are Ed's assets, his liabilities, and his owner's equity valued at? Are his accounts balanced? Assets are what Ed owns. With the information that's given in the example, we see that Ed has a store that's valued at $40,000 and equipment that's valued at $10,000. Liabilities are what he owes. So looking back, we see that Ed owes the bank $25,000 and his employee $15,000. Owner's equity is the amount of money that a company owner has personally invested in the company. Ed invested $10,000 when he bought the new equipment. In order to see if the account's balanced, we have to use the accounting equation. The accounting equation states that assets are equal to the sum of the total liabilities and owner's equity. Ed has $50,000 in assets. His total liabilities equal $40,000. His total owner's equity is $10,000. Let's plug this into the equation to see if Ed's accounts are balanced. Assets equals liabilities plus owner's equity. $40,000 plus $10,000 equals $25,000 plus $15,000 plus $10,000. $50,000 equals $50,000. So Ed's accounts are all in balance. Balance is the key when it comes to accounting. The accounting equation, which is written as assets equals liabilities plus owner's equity, shows the relationship between the three main categories of accounts. It helps to maintain balance in company accounts as well. The three categories of accounts that are part of the accounting equation are assets, liabilities, and owner's equity. Assets are what a company owns. Liabilities are what a company owes. Owner's equity is how much money that the company owner has personally invested in the business. In order to make sure that the accounts of a company are balanced, the total assets must equal the sum of the total of all liabilities and owner's equity. To see if everything is balanced, the totals are simply plugged into the accounting equation. Once the math is done, if one side is equal to the other, then the accounts are balanced. Kate owns an antique shop. This morning she got a phone call from her accountant asking her to bring her the source documents she has for the month. Well, Miss Brown, I'd be glad to, but I have no idea what source documents are, Kate says. Oh, Kate, Miss Brown says, I am so sorry I didn't explain. Source documents are pieces of paper that prove that a transaction occurred. Pieces of paper? Kate asked. What kind of paper? Well, Kate, Miss Brown says, source documents are anything that you get during the course of a transaction. It can be receipts from purchases and invoices from sales you made, whether they be sales on account or cash sales. Invoices that show you made purchases on account are also source documents. Checks you wrote to pay bills, deposit slips that prove you put a certain amount of money in the bank, or copies of paid bills, they're all source documents. Kate looks down at the scattered papers that are all over the counter. She gathers them up and begins to flip through them, pulling a few sheets out. Okay, she says, so I have receipts where I paid cash for merchandise that I bought last week. These are source documents, right? Yes, they are, Miss Brown says. Kate pulls another few pieces of paper out of the stack. And I have copies of the bills that I paid this month. Will these work as source documents? As long as it shows proof of a financial transaction, then yes, it is a source document, Miss Brown says. Well, now that I know what I'm looking for, I can get you what you need, Kate says. Okay, Kate says to herself. I think that I have it all together. I want to hand deliver these and find out why they're so important. Kate drives herself to Mrs. Brown's office armed with all the source documents she can find. She walks in and hands the items to Mrs. Brown. Thank you, Kate. That was pretty quick. I'm glad you brought these. I really need to get your books done. I was wondering, Miss Brown, can you explain to me why these are so important? Kate asked. I sure will, Kate, Mrs. Brown replies. Like I told you on the phone, source documents are proof that a financial transaction has occurred. Examining the source document is the first step in the accounting cycle. The source documents tell what kind of transaction occurred, what accounts are affected, and the dollar amount of the transaction. All this has to be decided before the journal entry is made. A journal entry is the recording of the date, accounts affected, and amount of a transaction into an accounting journal. An accounting journal is a record of accounting transactions in chronological order. So you see, without source documents, I couldn't even begin to do an accurate job for you. So let me get this straight, Kate says. Source documents can be receipts, copies of checks, copies of invoices, deposit slips, or anything else that prove that a transaction occurred. Accountants need source documents so that they can accurately document the financial transactions that occurred during an accounting period. Examining source documents is the first step in the accounting cycle and happens before a journal entry is made. A journal entry is where you record the date, accounts affected, and amount of a transaction. It's in an accounting journal, which is a record of transactions in chronological order. Am I correct? You sure are, Kate. Isn't it amazing how important a simple piece of paper can be in the accounting industry? Mrs. Brown asked. Have you ever seen a house being built? It's pretty amazing. The contractor starts with a basic foundation and keeps building on that. He adds walls, ceilings, floors, and a roof. Before long, the house is complete. Accounting concepts are a lot like that. It starts with a basic accounting equation, and before you know it, more concepts are being added. In the end, you have an extended accounting equation. The foundation of the entire accounting process is built on the one simple equation. That equation, called the basic accounting equation, shows the relationship that exists between assets, liabilities, and owner's equity. Assets are the things that you own. Liabilities are the things that you owe. Owner's equity is the amount of money that a business owner or owners have personally invested in a company. The basic equation states that assets equals liabilities plus owner's equity. Simply put, this equation means that in order for the company to have balanced finances, the total of all its assets must be equal to the sum of the total of its liabilities and owner's equity. That's saying a mouthful, isn't it? Let me use an example to help you understand. Barbara is a hairdresser, rents the building that her salon is in, but she owns all the equipment. Barbara has $1,500 in the bank. The total value of the equipment that Barbara owns is $15,000. Her annual expenses are $12,000, and the amount of equity that she has in the business is $4,500. Using the basic accounting equation, let's see if her finances are balanced. Assets equals liabilities plus owner's equity. $1,500 in the bank plus the $15,000 value of her equipment equals the $12,000 in annual expenses plus $4,500 of personal investment Barbara has in the business. $16,500 equals $16,500. Yep, her finances are balanced. But things aren't always as cut and dry as this information that we had on Barbara. The majority of the time, there are more components that have to be considered. What about the money that Barbara makes fixing hair? That has to have an accounting classification. Or what about more expenses that she may have? They have to fit into this equation somewhere. And what happens if Barbara decides that she wants to branch out into the hair design arena? She may have to have investors to do so. Well, those investors are the people who loan Barbara money for expansion. They want to get something in return. Let's decide what other accounting classifications fit the bill. Money that's brought in as payment for goods or services is called revenue. The money that is paid out of the company for items necessary for daily operation is called expenses. The money that's paid to investors as a return on their investment is called dividends. When you add those three accounting classifications to the basic accounting equation, you have something called the extended equation. The extended accounting equation is nothing more than the basic equation with the owner's equity section broken down into the three categories of revenue, expenses, and dividends. The actual formula for the extended accounting equation states that assets equals liabilities plus the revenue minus the total of the expenses and dividends. In reality, this concept is just as simple as the basic equation. Assets are still assets, and liabilities are still just liabilities. It's the added step of breaking down the owner's equity into the revenue, expenses, and dividends that makes this a little bit more time-consuming. To make it easier, just remember that owner's equity equals the revenue minus the total of the expenses plus the dividends. Let's talk about Barbara again. One day, Barbara decided that she wanted a special kind of scissors to use in her salon. She couldn't find what she wanted, so she drew up her own design and had a friend make them for her. The scissors were fantastic. She showed them to a few cosmetologist friends of hers, and they each wanted a pair. Barbara decided that she should get a patent on the scissors and then start a business making them. She called the business Colossal Shears, and even had a few good friends invest money to get the business up and running. Within a few months on the market, Colossal shares became bestsellers. Barbara was glad that she could not only pay her bills, but also give her investors a small return on their investments. Below is what Barbara's finances looked like at the end of the first year. Her assets were equal to $57,000. Her liabilities equaled $29,000. Her revenue was $65,000. Her expenses were $24,000. She paid dividends to her investors in the total of $13,000. We're going to use the extended accounting equation to see if the finances of Colossal shares are in balance. Once again, the extended accounting equation states that assets equals liabilities plus the revenue minus the sum of expenses and dividends. If we plug in the numbers for each category, the equation will look like this. $57,000 equals $29,000 plus $65,000 minus the total $24,000 plus $13,000. $57,000 equals $29,000 plus $65,000 minus $37,000. $57,000 equals $29,000 plus $28,000. $57,000 equals $57,000. Both sides of the equation are equal, so the finances of Colossal shares are balanced. Accounting begins with a simple equation called the basic accounting equation. This equation, written as assets equals liabilities plus owner's equity, shows the relationship that exists between assets, liabilities, and owner's equity. Assets are what you own. Liabilities are what you owe. Owner's equity is the amount of money that a business owner or owners have personally invested in the company. As more transactions take place in a business, then more account types are involved, and the basic accounting equation grows to include them. This new equation is called the extended accounting equation. The extended accounting equation is the basic accounting equation with the owner's equity section broken down into three more categories of accounts: revenue, expenses, and dividends. Revenue is money brought into a company from the sale of goods or services. Expenses are payments made by the company for items that are essential to the normal daily operations of the company. Dividends are money paid to investors as a return on their investments. In its written form, the extended accounting equation looks like this. Assets equals liabilities plus revenue minus the sum of expenses and dividends. Though it may look scary, it really is simple. All you have to do is remember that owner's equity is the only thing that changes between the basic and the extended accounting equation. In the end, you'll be like the contractor that just finished a house. He started with the foundation, and by the time he added all the parts, he had a completed house. Have you ever put together a jigsaw puzzle? Personally, I enjoy it. I find a good deal of satisfaction in the ability to take all these pieces and put them together to make a final picture. When I think about the role of accounts in accounting, it reminds me of a puzzle. Each account is one small part of the entire picture. What exactly is an account? The textbook definition of an account is that it is a place to record transactions that occur within a business. But to me, an account is just a piece of the puzzle. There are three main categories of accounts that are used in accounting. They are assets, liabilities, and owner's equity accounts. Assets are things that a company owns. Liabilities are things that a company owes. Owner's equity is the amount of money that an owner invests into the business. Every single financial transaction that occurs in a business falls into one of these three categories. It's the job of an accounting professional to decide what category that is. Asset accounts are broken down into two subcategories: current assets and non-current assets. Current assets are those assets that will be used up or sold within 1 year. Cash is a current asset. Another current asset is accounts receivable, which is what others owe to you. Another example of a current asset is prepaid expenses. Prepaid expenses are expenses that have been paid in advance and will be expensed out throughout the year. Inventory and supplies are two other examples of current asset accounts. Non-current assets, also called long-term assets, are things that a business has that will not be used up or turned into cash within a year. Examples of non-current assets are land, buildings, and equipment. Like asset accounts, liability accounts are also broken down into current and non-current subcategories. Current liabilities are bills or any other debt obligation of a company that is due within 1 year. Payroll expenses, utility bills, and short-term loans are good examples of current liabilities. Non-current liabilities are debt obligations that will extend for longer than 12 months. Payments on big-ticket items such as machinery, land, and buildings are good examples of non-current liabilities. The final type of account classification that is used in accounting is owner's equity, oftentimes just called equity. Equity accounts are further broken down into the owner's capital account, which is where his direct investment is categorized, and stockholders' equity, which is where any equity that comes from the sale of stocks or bonds and any investments by stockholders is categorized. Before you can start to put the accounting puzzle together, there's one more piece of information that you need to know. The most common form of accounting that is used today is called double entry accounting. Double entry accounting states that for every one transaction, 2 or more accounts will be affected. Now let's look at a few examples to see how all this works. Bob's Auto Repair is a pretty busy place. Since Bob services all makes and models of vehicles, he must keep a number of different parts in stock. Each week, Bob places an order for stock inventory from Bill's Auto Emporium and charges them to his charge account. This week, his order totaled $2,540.67. When Bob's bookkeeper analyzes this transaction, what accounts will be affected? For this transaction, there will be both an asset and a liability account that is affected. The asset account will be inventory, which will have a balance increase of $2,540.67. The liability account that will be affected will be accounts payable, which will have an increase in the same amount. A few weeks later, Bob pays his bill at Bill's Auto Emporium in the amount of $9,972.34. What accounts are affected in this transaction? Once again, this transaction affects an asset and a liability account. The asset account, cash, will have a decrease in its balance of $9,972.34. The liability account, accounts payable, will also have a decrease in its balance in the same amount. As you can see, using Bob's Auto Repair as an example, every transaction does affect at least 2 accounts. Once all transactions for an accounting period have been analyzed and recorded, then it's time to put the pieces of the puzzle together. The end result is a picture of the true financial health of the company. An account is a place to record transactions that occur within a business. Accounts are divided into 3 specific categories: assets, liabilities, and owner's equity. Assets are things that a business owns. Liabilities are things that a company owes. Owner's equity is the amount of money that company owners have invested in the business. These 3 types of accounts are used as the main classifications of accounts. The asset and liability categories are broken down into 2 subcategories. These 2 subcategories are current and non-current. Current assets are those assets that will be used up or sold within 1 year. Non-current assets, also called long-term assets, are things that a business has that will not be used up or turned into cash within a year. Current liabilities are bills or any other debt obligation that is due within 1 year. Non-current liabilities are debt obligations that will extend for longer than 12 months. The owner's equity accounts may also be broken down into 2 different subcategories. They are the owner's capital, which is where direct investments are categorized, and the stockholders' equity account, which is where any equity that comes from the sale of stocks or bonds is categorized, as well as where investments by stockholders are classified. Each and every transaction that occurs in a business is analyzed and recorded in at least 2 accounts. Why, you ask? Well, remember that the most often used system of accounting in the modern accounting industry is double entry accounting. Double entry accounting states that for each transaction, at least 2 accounts will be affected. Once every transaction is analyzed and every entry is made into the appropriate account, the numerous pieces of the puzzle are put together and one big financial picture is complete. Before you can completely understand the process of accounting, you have to understand the key concepts of the accounting industry. 2 of those concepts are the ledger and the chart of accounts. The ledger, which is also known as the Book of Final Entry, is the book or computer printout that contains the accounts. The chart of accounts is a listing of all accounts that are related to a company. Each and every transaction in the business world results in a change to the balance of at least 2 accounts. It's important to note here that accounts usually have their own specific account number. There are 2 kinds of ledgers. A general ledger contains information on all the accounts, while a subsidiary ledger contains information that is specific to a certain general ledger account. If you're using a manual accounting system, you'll be using an actual book to record information in the ledger. If you're using a computerized accounting system, your ledger information will be in the form of computer printouts and will be contained within the computer program itself. Regardless of the type of ledger that you're using, the purpose of the ledger is to record specific information about transactions that affect the balance of the ledger account. The chart of accounts is broken down into asset, liability, owner's equity, revenue, and expense accounts. Asset accounts are accounts that show what a company owns. Liability accounts are accounts that show what a company owes. Owner's equity accounts are accounts that show how much money company owners and investors have invested in the company. A revenue account is an account that is set up to record the inflow of money earned from company operations, while expense accounts are accounts that are set up to record the outflow of cash related to company operations. So how do the ledger and the chart of accounts relate? The answer to that is pretty simple. The chart of accounts is one of the first things created when a business opens. Some say it's the blueprint of the business, since the chart of account contains all the accounts that will appear on the balance sheet and income statement. Once the chart of accounts is created, then and only then can the ledgers be created. The ledger and chart of accounts are both very important for a business. The ledger is the book that contains all the accounts. There are 2 types of ledgers. The general ledger, which contains information on all the company accounts, while the subsidiary ledgers contain information about specific individual accounts. The chart of accounts is a listing of all accounts that a company has. There are 5 categories of accounts that make up the chart of accounts. They are asset, liability, owner's equity, revenue, and expense accounts. Asset accounts are accounts that show what a company owns. Liability accounts are accounts that show what a company owes. Owner's equity accounts are accounts that show how much money company owners and stockholders have invested in the company. Revenue accounts are accounts that show the cash inflows of a company due to operations, while expense accounts are accounts that show the cash outflows of a company due to operations. Once the chart of accounts has been established, then a company is ready to begin the process of accounting. For every action, there is an equal and opposite reaction. Have you ever heard that phrase? A couple of hundred years ago, that phrase was uttered by a man named Sir Isaac Newton, a world-renowned mathematician and physicist. Newton made that statement when he was discussing laws of motion in physics. Isn't it amazing that here we are, hundreds of years later, and that one statement can be used to explain debits and credits in accounting? Before we get too involved in the discussion of debits and credits, let's learn a few basics. Every business has various transactions that occur each day. Each of these transactions are examined by accountants and recorded in the accounts that they affect. In the first steps of accounting, accounts are broken down into T accounts. T accounts are simply visuals to help accounting professionals see the effects of transactions on accounts individually. The accounting system that is used most often this day and time is called double entry accounting. Double entry accounting requires that every business transaction be recorded in at least 2 accounts. One account will be debited and one account will be credited. So now that you have the basics down, let's talk a little bit about what debits and credits are. Debits and credits are both forms of notation that are used in accounting to keep the balance in accounts. A debit is an entry on the left side of the T account that increases asset and prepaid expense balances and decreases liability and equity account balances. A credit, the opposite of a debit, is an entry on the right side of the T account. It increases liability, expense, and owner's equity accounts and decreases asset and prepaid expense accounts. It can seem a little confusing to understand debits and credits, so let's look at an example. Peggy owns a dressmaking shop. It's taken her 2 months, but she's just finished an elegant wedding dress for a customer. The customer paid a $200 deposit on the dress before Peggy made it. She comes in and picks up her dress and pays Peggy the $400 that she still owes on the dress. The total cost of the dress is $600. Using this example, you can see that Peggy was given $400 today for a balance due on a dress. That $400 is a debit to the cash account. This debit increases the cash balance by the $400. Cash is an asset account. Since a deposit was made on the dress, it was sold on account, meaning that it is an accounts receivable. Since Peggy uses a double entry accounting system, she must have a credit that equals that debit. For this instance, the credit, which is $400, will go to the accounts receivable. Remember Newton's comment from the beginning of this lesson? For every action there is an equal and opposite reaction. That's exactly what happens with debits and credits. For every debit there is a credit, and for every credit there is a debit. One entry increases the value of an account, while another decreases the value of an account. This keeps accounts balanced, which is what the main purpose of accounting is, to balance. Look at Peggy's dress shop. For one transaction, there were 2 entries made to accounts. One entry added $400 to an account balance, and one entry subtracted $400 from an account balance. In this example, $400 minus $400 equals 0. The transaction, once zeroed out, is considered balanced. Debits and credits are fundamental parts of the double entry accounting system. The double entry accounting system requires that every business transaction be recorded in at least 2 accounts. One account will have a debit entry and one account will have a credit entry. A debit is an entry that increases the asset and prepaid expense account balances and decreases the liability, expense, or equity account balance. Just the opposite, a credit is an entry that increases the balance in a liability, expense, or equity account balance and decreases the balance in an asset or prepaid expense account. The easiest way for accounting professionals to see the results of each transaction is to create T accounts. T accounts are visuals that accounting professionals use to see how accounts are affected by the debits and credits of business transactions. Debits are recorded on the left side of the T accounts, while credits are recorded on the right side of the T accounts. When the total debits of a transaction is added to the total credits of the same transaction, the ending result should be 0. This means that the transaction is balanced. The best way to remember the purpose of debits and credits is to remember that age-old saying that is accredited to Newton. For every action there is an equal and opposite reaction. Remembering that will help you effectively use debits and credits to achieve the one thing accounting is famous for: balance. Did you know that millions of times a day, all over the world, transactions occur? Think about it. Any time that a bill is paid, a loan is made, a purchase is made, or a sale is made, a transaction has occurred. A transaction is any event that involves goods, services, or money changing hands. For the average person, a completed transaction simply means that something on their to-do list has been completed. To the accounting professional, a completed transaction is just the beginning of something even bigger. It's the beginning of the accounting cycle. The accounting cycle is the series of events that begin with a transaction and end with the closing of the books for an accounting period. In this lesson, we're going to talk about the first step in the accounting cycle, transaction analysis. What is transaction analysis, you wonder? Transaction analysis is the act of examining a transaction to decide how it affects the accounting equation. Now, in order to analyze a transaction, you must know what it is you're looking for. Accountants are equipped with a very special tool that they use when analyzing transactions. That tool is the accounting equation. The accounting equation states that assets equals liabilities plus owner's equity. An asset is something that a business owns. A liability is something that a business owes. Owner's equity is the amount of money that a business owner personally invests in the business. Every account that a business has falls into one of these three categories. Another important thing to know before you can analyze a transaction is that accounting professionals use a double entry accounting system. A double entry accounting system is one that's based on the premise that for every one transaction, at least two accounts will be affected. So what does this mean? It means that at least one account will be debited and one account will be credited. A debit is an entry on the left side of an account that signifies an increase in the balance of an asset account and a decrease in the balance of a liability or owner's equity account. A credit is an entry on the right side of an account that decreases the balance of an asset account and increases the balance of a liability or owner's equity account. The last thing that you really need to know before you can begin transaction analysis goes back to the accounting equation. If you recall, the accounting equation states that assets are equal to the sum of the total of liabilities and owner's equity. The key to this is in the word equals. The same premise applies to transaction analysis as it does to the accounting equation. The bottom line is that everything must balance. The best way to learn about transaction analysis is to analyze transactions. So let's do a few. Jeff orders $275 worth of supplies for his company from Reed's Wholesale. He pays for them with a check. What accounts are affected by this transaction and how are they affected? Jeff bought supplies, so that means that the balance in the supplies account increases $275. So it's debited in the amount of $275. He paid for the supplies with a check, so that means that the cash account decreases $275 and is credited $275. Jeff receives the utility bill for his business office. The bill is $547. For this transaction, the two accounts that are affected are utilities expense and accounts payable. The utilities expense account increases $547. Since this account is an expense account, a debit increases the balance in that account. The credit for this transaction is to accounts payable. Since accounts payable is a liability account, its balance also increases by the credit amount of $547. As you can see from the examples, there are always at least two accounts that are affected by a transaction. Even though one is debited and one is credited, that doesn't mean that one account will increase and one will decrease in value. It depends on what type of account that it is as to whether the account balance increases or decreases. Transaction analysis is the act of examining a transaction to decide how it affects the accounting equation. It's also the first step in the accounting cycle. In order to properly analyze a transaction, you must know and understand a few key things. First, you need to know what the components of the accounting equation are. Assets are things that a business owns, liabilities are things that a business owes, and owner's equity is the amount of money that a business owner has personally invested in the business. Second, you need to know what debits and credits are. A debit is an entry on the left side of an account that signifies an increase in the balance of an asset account and a decrease in the balance of a liability or owner's equity account. A credit is an entry on the right side of an account that decreases the balance of an asset account and increases the balance of a liability or owner's equity account. The third thing that you need to know before you can analyze business transactions is that no matter what, the sum of the amounts debited and credited must be equal. Once you know these concepts, transaction analysis will be a breeze.
Have you ever heard the old saying that there is a place for everything and everything in its place? There is no industry where that saying is more appropriate than accounting. Every single transaction that occurs in the life of a business is written down in a special book called a journal. The journal is also known as the Book of Original Entry. The entries made in the journal are appropriately named journal entries. Transactions are recorded in chronological order and always have both a debit and a credit line. Why two lines for every one transaction? Because the form of accounting used most often in the accounting industry is called double entry accounting. Double entry accounting requires that for every one transaction that occurs in a business, there are at least two accounts affected. One account is debited and one account is credited. A debit is an entry on the left side of an account, while a credit is an entry on the right side of an account. Why are journal entries important? Since journal entries involve at least two accounts, that means at least two accounts have a change in their balances. When account balances change, then so do the overall finances of the business. Let's look at an example. Joe is a mechanic. On February 1st, he bought a new alternator to repair a car in his shop. The cost of the alternator was $249. This is a business transaction that needs to be journalized. The journal entry will look like this. Notice the form of the journal entry. The date is always listed first, followed on the same line by the name of the account that is debited and the amount of the debit. On the line underneath this, the name of the account that is credited is listed, along with the amount of the credit. The credit line is always indented below the debit line. The third line of the journal entry is a brief description of the transaction. Once each transaction has been journalized in the journal, the entries are posted or transferred to the general ledger. The general ledger is the listing of all transactions of a company that are itemized by the specific account. The general ledger is also known as the Book of Final Entry. At the end of an accounting period, after all the journal entries have been made, accounting professionals create what is called a trial balance. A trial balance is a list of all the accounts of a business and their balances. Since each business account falls into one of three major categories, asset, liability, or owner's equity, they each have what is called a normal balance. Asset accounts are those accounts that are related to items that the business owns, such as supplies, inventory, buildings, and equipment. These types of accounts normally have a debit balance. Liability accounts are those accounts that are related to items that a company owes, such as utilities expense, payroll expense, and loans payable. Liability accounts normally have credit balances. Owner's equity accounts are accounts that are related to personal investments that are made by owners of the business, such as the owner's capital account and stockholders' equity accounts. These types of accounts, like liability accounts, normally have a credit balance. The main reason that a trial balance is created is to check the accuracy of the mathematical calculations made to each account balance as a result of journal entries. If the total amount in the debit column of the trial balance equals the total amount in the credit column of the trial balance, the assumption is made that the accounts are in balance. Look at the example trial balance of XYZ Corporation. As you see, the trial balance is formatted rather simply. Account names are in the first column, with their corresponding balances in the next columns. An account with a debit balance has the account balance listed in the second column, while those with a credit balance have their account balances appear in the third column. It is the second and third columns that are totaled individually and compared. A journal, which is also called the Book of Original Entry, is a record of each transaction that has occurred in a business. The entries made in the journal are called journal entries. Each journal entry is recorded using the double entry accounting method. The double entry accounting method states that for every one transaction that occurs, at least two accounts will be affected. One account will be debited and one account will be credited. A debit is an entry made on the left side of an account, while a credit is an entry on the right side of an account. These entries, which are recorded in chronological order, each have an effect on account balances. Once transactions have been journalized, they are posted. To post a journal entry means to transfer that entry to the general ledger. The general ledger, which is also known as the Book of Final Entry, is a listing of all transactions of a business that are separated by individual accounts. At the end of an accounting period, after all the journal entries are made and posted, a trial balance is generated. The trial balance is a listing of all the accounts that a business has and their balances. Some of the accounts have debit balances and some have credit balances, depending on the type of account. In the end, the total dollar amount of debit account balances must equal the total dollar amount of credit account balances. If the balances match, then the accounts are assumed to be in balance.
Have you ever heard the term financial information? I'm sure that most of us have. The term financial information in the accounting industry refers to information found on the financial statements of a company that tells how good or bad a company is performing. Now that you know what it means, do you have any idea why financial information is important? Financial information, as seen on the financial statements, gives users of this information, which is usually creditors, investors, and potential creditors and investors, the tools they need to make informed decisions about their interactions with the company. The financial statements provide all of a company's financial information. They're the income statement, the statement of retained earnings, the balance sheet, and the statement of cash flows. Together, these reports tell the story of how well a company is operating and how much of a risk investing in that company would be. Now, sometimes there are problems that occur when creating the reports that provide the financial information. Some of the most common problems that occur in the reporting process are reporting errors. Reporting errors are errors that are a result of such things as miscalculations or transposing numbers. For example, let's say that Henry is the bookkeeper for Wasabi International. While calculating the net income for the company, Henry added $5,000 that really should have been subtracted from the company's income. This miscalculation means that the net income for the quarter is overstated. Another problem that may occur when deciding what to include on the financial reports involves disagreements in judgment. Now, this term should be pretty self-explanatory. In simple terms, it means that what I believe and what you believe may not be the same. I bet you're wondering how this can possibly have anything to do with financial information. Well, let's look back at Henry and another situation he's run into when preparing the financial statements. Wasabi International recently had to replace a machine that's used on the production line. The terms for the purchase of the machine are for the company to pay half of the cost up front and the balance when the machine is completely installed. Henry decides that he needs to report the portion of the expense in this accounting period that was actually paid out. His supervisor, Mark, wants to wait and report the expense in another accounting period. Either option is acceptable. However, there will be a difference in the net income reported on the income statement as well as the information on the statement of cash flows. If Henry reports the expense now, the net income will be less and the cash outflow will be a whole lot more. But if he waits to report the expenses until the next accounting period when the machine installation is complete, then the current period will show a better net income and less cash outflow. Most of the time, disagreements in judgment are related to the timing that the expenses are reported. The third problem that we're going to discuss is fraudulent financial reporting. Fraudulent financial reporting means to deliberately omit or misstate financial information with the intent of deceiving investors and creditors. This is the one action that is anything but an honest mistake. Fraudulent reporting practices are such things as changing the amount paid to a vendor, changing the amount of income that's received by a company, failure to report expenses, and that's just to name a few. These types of activities usually occur because of the desire to pad the financial statements or make them look better. Let's go back to Henry again. What would happen if Henry decided that he didn't want to report the expense of purchasing the new machine at all? He knows that if he does report it, then the company's going to have a lower net income in this accounting period compared to the prior accounting period, and that's not what creditors and investors want to see. However, not reporting the expense is definitely a fraudulent reporting practice. Financial information refers to information found on the financial statements of a company that tells how good or bad a company is performing. There are 4 reports called the financial statements that provide all of the company's financial information. They're the income statement, the statement of retained earnings, the balance sheet, and the statement of cash flows. 3 typical problems that occur when creating the financial statements are reporting errors, disagreements in judgment, and fraudulent financial reporting. Reporting errors are errors that are a result of such things as miscalculations or transposing numbers. Disagreements in judgment simply means that what I believe and what you believe may not be the same. Fraudulent financial reporting means to deliberately omit or misstate financial information with the intent of deceiving investors and creditors. Each of these problems have a major impact on the financial statements, which in turn has an effect on the financial information that is used by potential and current creditors and investors that a company may have. Can you imagine what life would be like if we lived in a world where there were no rules? People would do just what they wanted, how they wanted, and when they wanted. It would be complete chaos. Now imagine if there were no rules in accounting. A company could report any amount of income and expenses that they wanted to, and we would never know how sound the company was. That's exactly why internal controls are important. Internal controls in accounting are procedures that are put in place within an organization to ensure business is carried out in an orderly, effective, and accurate manner. There are four main purposes of internal controls in the accounting industry. The first of those is to safeguard the assets of a company from any form of loss. The loss could be an accidental loss, which occurs from honest mistakes being made by individuals, or it could be an intentional loss, which results from intended fraudulent activities. A second purpose for internal controls is to ensure that financial information is accurate, reliable, and timely. A third and very important purpose of internal controls is to ensure compliance with federal, state, and local business laws. To ensure compliance in the accounting industry, the Securities and Exchange Commission created a special group called the Financial Accounting Standards Board, the FASB. The FASB sets the guidelines that all accounting professionals must follow. The guidelines that the FASB set are called Generally Accepted Accounting Principles, or GAAP. The fourth major purpose of internal controls is to provide a way for companies to monitor goals that it has set for itself. Now that you know what internal controls are and what kinds of internal controls are most common, let's look at a few examples to increase your understanding. Ted is a bookkeeper in the accounting department of a local department store. He notices that one of the clerk's registers is out of balance. Looking through the register information, he sees that the clerk charged the wrong amount of money for a product. Instead of charging $97 for a DVD player, she charged $79. This was a transposition in numbers error and was not an intentional loss. Well, a few weeks later, Ted begins to notice a pattern of transposition errors with that one specific clerk. Upon investigation, he realizes that the employee is ringing up items with wrong prices for another employee. That's a loss due to intended fraudulent activity and a perfect example of the first major purpose of internal controls, protection of assets from loss. At the end of every month, Ted is responsible for preparing monthly financial statements. He gives these financial statements to his managers for their review. They use the financial statements to get a mental picture of how well the company is doing and where changes may need to be made to maximize profit. Ted has to be sure that the information presented on the financial statements is valid, reliable, and accurate, which is exactly what the second purpose of internal controls is. While preparing all the necessary financial documents for company leaders, Ted also has to keep in mind that current and potential creditors and investors are also interested in this information. He knows that whether it's good or bad, he has to report information that is truthful and accurate. But why does it matter? Because the FASB and GAAP require that it be, which exemplifies the third purpose of internal controls. Ted has one more big responsibility on his shoulders. His company has a goal of increasing their profit margin by $10,000 at the end of every year. The plan that company leaders laid out was to keep on-hand inventory at a minimum so that at the end of the year, the cost of inventory on hand wouldn't eat away their profit. Ted's job is to ensure that each dollar amount spent on inventory is used in the appropriate period. So if inventory is ordered at the beginning of the month, that inventory should be used by the end of the month with no leftovers. With Ted closely monitoring the cost of inventory on hand at the beginning of the month, as well as the amount of on-hand inventory at the end of the month, he can create an accurate report for company leaders to see how well they're meeting their goals. Internal controls in accounting are procedures that are put in place within an organization to ensure business is carried out in an orderly, effective, and accurate manner. There are 4 reasons that internal controls within an organization are important. First, internal controls are important for safeguarding any assets that a company has from loss, whether that loss is accidental or intentional. Accidental loss is loss that occurs due to honest mistakes being made by individuals. Intentional loss is loss that results from intended fraudulent activity. Next, internal controls assist in ensuring that financial information is accurate, reliable, and timely. A third reason that internal controls are important is because they help accounting professionals comply with federal, state, and local business laws. To help in this goal, the Securities and Exchange Commission created the Financial Accounting Standards Board, which is also known as the FASB, to set the guidelines that all accounting professionals must follow. These guidelines are called the Generally Accepted Accounting Principles, or GAAP for short. The fourth important reason that internal controls are important is because they give a company a way to monitor goals that have been set for themselves. Each of these reasons makes internal controls vital parts of a company's operation. Have you ever wondered just how safe your money is when you deposit it in the bank? I used to, but then I did a little research on the safeguards and controls of banking activities, and I don't worry so much anymore. You see, my research showed that the banking industry is one of the most highly regulated industries in the world. And because of this, they have stringent safeguards and internal controls in place. Safeguards are measures that are taken to prevent someone or something from an undesirable outcome. Internal controls are rules and regulations that are put into place to guard assets owned by a person or a company. These two terms seem to mean the same thing, but in reality they don't. You see, the rules and regulations that are put into place, which are internal controls, are the measures that are taken to prevent something or someone from an undesirable outcome, which are safeguards. There are 5 goals for having effective safeguards in place in the banking industry. To begin with, effective safeguards and internal controls provide reasonable assurance that banks operate efficiently and effectively. They also ensure that each transaction that occurs in the bank is recorded correctly. The third goal of effective safeguards is to make sure that the information provided by banks is true and reliable information. Yet another goal of banking safeguards is to make sure that the risk management system in place in the bank is effective. And the final goal is to make sure that all the banking laws and regulations are being complied to. Now that you know what a bank's goals are for having safeguards and internal controls, how do they manage to achieve those goals? Well, the key to this is having written policies and procedures in place that must be followed by all employees. A specific component that must be a part of the policies and procedures is the separation of duties. What do I mean when I say separation of duties? Separation of duties means to separate one big job into smaller jobs with a different individual performing each. Let's look at a banking scenario and see how the process flows. Jenny, Christy, Chelsea, Faith, Jared, and Blake all work at the First Bank of Tata. Jenny's a teller. At the beginning of her workday, her bank protocol says that she needs to count her drawer to ensure that it contains the correct amount of currency. The rest of her day she spends taking customer deposits, customer loan payments, cashing checks, and making change. At the end of the day, again per bank protocol, she totals up the deposits and loan payments that she's taken in and the checks she's cashed, and then balances her drawer again. She turns all the cash and checks that she has received, along with all associated paperwork, into the head teller, Christy, at the end of the day. Christy is the head teller. She's responsible for all the customer service duties of a regular teller, as well as the direct supervision of the other tellers. She's also responsible for retrieving money from the vault as needed to make change for the teller drawers, and collecting all daily paperwork and reports that each teller generates. Christy turns all the daily paperwork over to Chelsea. Chelsea works in the bookkeeping department. It's her job to process all the documents that Christy gives her at the end of the day and check them against the reports that are pulled from the computer. Checks are then scanned and electronically dispersed to the Federal Reserve. Once everything is verified and copies are all scanned, the checks are then sent to the document shredding department and shredded. Faith works in the loan department of the bank. Faith does not take deposits or payments, and she does not cash checks. Instead, she meets with bank customers who are seeking a bank loan. She takes the application and submits it to the credit department at the bank. Jared works in the credit department. He doesn't take deposits or payments. He doesn't cash checks. He doesn't take loan applications. Jared runs the credit reports and does all the legwork that needs to be done to verify whether a loan package can be offered to a customer. He also writes the loan paperwork. The loan paperwork is then sent back to Faith so that she can meet with the customer and have him sign the papers. She then gives him something to take to Jenny so that she can deposit the loan proceeds to the customer's account. Blake is a compliance officer. He spends his day reviewing the work of Jenny, Christy, Chelsea, Faith, and Jared. He has to make sure that they're following the protocol that is defined in the bank's procedures manual. If not, then he's responsible for letting the bank's presidents know. Do you see the separation of duties here? None of the 6 people that we talked about do the same job. However, each of their jobs collectively fulfill the purpose of the bank, which is to provide quality customer service. Having each of the employees do a different job is an important safeguard. It allows for the internal control system to not only be followed, but to be monitored closely. Safeguards and internal controls are important concepts in the banking industry. Safeguards are measures that are taken to prevent someone or something from an undesirable outcome. Internal controls are rules and regulations that are put into place to guard assets owned by a person or a company. The tie that binds the two concepts is rather simple. Internal controls are the safeguards that banks put into place to protect customer assets. There are 5 goals of having safeguards in the banking industry. They are to provide assurance that banks are operating efficiently, to ensure that transactions are recorded correctly, to make sure that information provided by the bank is true and reliable, to ensure that risk management systems are effective, and to make sure that banking laws and regulations are being complied to. The best way to ensure that these goals are achieved is to have written policies and procedures in place that consist of distinct separation of duties. Separation of duties means to separate one big job into several smaller jobs with a different individual performing each. Having this system of safeguards and controls allows for customers in the banking world to feel confident that their money is being protected. One of a company's most important accounts is their cash account. It's also the most vulnerable to fraudulent activity. Because of this, companies need to make sure that they have adequate cash controls in place. What is cash control? Cash control is a way to monitor credit, collection, cash allocation, and disbursement policies, as well as invoicing functions. Before we can talk about cash control methods, you need to first understand what it is that makes up the cash account. I bet you think it's just plain cash, right? Well, actually, that's not the case. The cash account is made up of cash and cash equivalents. Cash is essentially defined as money or anything else, such as coins, money orders, or banknotes, that a bank will accept as a deposit to a business's account. Also included in the category of cash are things called cash equivalents. Cash equivalents are liquid assets that can be turned into cash within a short period of time and that aren't affected by changing interest rates. The higher the liquidity value of a cash equivalent, the quicker it can be turned into cash. The term liquidity refers to how quickly something can be turned into cash. An example of a highly liquid item would be a 90-day CD. This item isn't cash that can be deposited into a bank account and credited immediately, but in 90 days it can be changed over to cash easily and deposited. The cash account is the one account that can easily fall prey to fraudulent activity. Because of this, it's very important that a company put into place guidelines for managing the cash account. There are a few common aspects of internal control that can and should be used by all companies. To begin with, there needs to be a separation of duties. Along with separation of duties, there needs to be written protocol for cash handling and disbursement. Let's look at an example below. Ed owns a retail store. Each employee is given a copy of the company's policies and procedures manual. Ed has the following instructions on cash management in his manual. Cash is to be moved from the register at the end of each shift. The cash register attendant will run the daily sales report and take the cash and the report to the accounting assistant. The accounting assistant will verify the cash sales for the day and prepare and make the daily deposit. The accounting assistant will then give the deposit slip and a copy of the daily sales report to the staff accountant. The staff accountant will record the deposit in the accounting system. The accounting assistant will enter all bills into the accounting system and file the bills in the appropriate location in the office of the staff accountant. The staff accountant will prepare bills for payment and print checks on a weekly basis. The staff accountant will bring checks that need to be signed to the company owner for his signature. The accounting assistant will perform the monthly bank reconciliation and have it reviewed by the staff accountant. Phyllis, Mary, and Evelyn all work for Ed's retail store. Phyllis works the cash register. Mary is the accounting assistant, and Evelyn is the staff accountant. When a customer purchases an item, Phyllis takes the payment. At the end of the day, Phyllis takes the cash from her register along with a sales report to Mary. Mary counts the cash, verifies that the total is the same as the sales report, and takes the deposit to the bank. Then she turns the deposit slip over to Evelyn. Evelyn records the deposit in the accounting records. At the end of every week, Evelyn writes the checks for the bills and takes the checks to Ed to sign. Do you see the separation of duties in this example? And what about the employees following written protocol? Do you see how each step in the cash management process is handled by a different person? This allows individuals to check behind the others. This in no way means that fraudulent behavior is expected to occur from any of the employees. It simply means that the company has set up internal controls to ensure that they are reporting financial information as accurately as possible. Internal controls are an excellent way to safeguard the assets of a business. Since a company's cash account is the most vulnerable to fraudulent activities, cash control, a way to monitor credit collection, cash allocation, and disbursement policies, as well as invoicing functions, is a necessity. In order to fully protect cash assets, you first have to realize that the cash account is made up of both cash and cash equivalents. Cash is money or anything else such as coins, money orders, or banknotes that a bank will accept as a deposit to a business's account. Cash equivalents are liquid assets that can be turned into cash within a short period of time and that are not affected by changing interest rates. The term liquid refers to the liquidity value of the cash equivalent. Liquidity refers to how quickly something can be turned into cash. Because cash is so vulnerable to fraud, company owners must establish internal controls to protect their assets. Internal controls in this area refer to the guidelines for managing the cash account. Two very important components that need to be part of an effective cash management internal control system are the separation of duties and written protocol for cash handling and disbursements. Having a formal cash control system in place makes the process of cash management much simpler. I have a Great Dane. His name is Turk, and he's usually the most well-behaved of all my dogs, until you throw a loaf of bread into the mix. A loaf of bread is his downfall. Temptation just overtakes him and causes him to throw caution to the wind. Every chance he gets, he snatches bread off the counter, and I get frustrated. However, I've not been able to establish a good set of internal controls to keep this situation from happening. Internal controls, you wonder? What does that have to do with a dog? And what does either of those things have to do with control of cash receipts and disbursements? Well, I'm glad you asked. You see, internal controls are rules and regulations that are put into place to guard assets owned by a person or a company. When it comes to Turk and me, the asset I need to safeguard is bread. In the business world, there's one asset that needs more protection than any other, and that asset is cash. Now, there are two areas that need to be addressed when discussing cash control: receipt and disbursement. So let's begin our discussion with receipt controls. Cash receipts are money received from consumers for the sale of goods or services. Now, an effective internal control system will have written documentation explaining how that cash should be handled when it is received, as well as separation of duties. Separation of duties means to separate one big job into several smaller jobs with a different individual performing each. In a good cash control system, there would be one person that collects money, one person that enters the transaction into the accounting system, and one person who makes the bank deposit. Each activity should have a paper trail that matches. For example, the daily sales report should match the amount of cash received for the day. The audit report and the transactions entered for the daily sales should match. The bank deposit receipts should match the daily transaction report. In a nutshell, everything should cross balance. Now, it's a good rule of thumb to never ever give free rein to one single employee to collect and report the cash account activities. Any employee can fall victim to temptation, and reason goes right out the window. Having an effective internal control system would deter such behavior. Now, cash disbursements are monies that are paid out to individuals for the purchase of items that are needed and used by a company. This can be anything from purchasing inventory, raw materials, or even utilities. Regardless of the reason for the cash disbursement, there must be internal controls in place to safeguard against fraud. A good internal control system will break down the cash disbursement responsibility into at least two separate jobs. One person should be responsible for entering bills into the accounting program and printing the payment checks, and another person should be responsible for signing those checks. Separating these duties once again enables there to be a system of checks and balances. Without it, temptation could rear its ugly head and cause an otherwise rational person to do questionable things. Checks could be written and signed by the same person and used for whatever they wanted. Bills could bogusly be put into the system just for an individual to write themselves a check. Any number of things could happen. So let's apply these concepts to a practical example. Emily is the owner of Emily's Pet Emporium. She has a number of employees that work in the store, but only 6 that are directly related to cash handling activities. Lane and Lana are cashiers. They're responsible for taking money from customers in exchange for merchandise sold. At the end of their shifts, they each run a sales report and put the money collected for the day into a bank bag. They take the bank bag to Hannah. She works in the accounting office. Hannah counts each bag and verifies it against the totals on the sales report, and then writes up the bank deposit slip. Once she's completed that, she takes the bags to Dottie, who also works in the accounting department. Dottie reviews the sales report information and the bank deposit slip and takes the deposit to Laura, who's in charge of taking the deposit to the bank, as well as getting the mail from the post office. When Laura returns, she gives the deposit receipt to Dottie, who staples the receipt from the bank to the sales report and files them. She also enters the deposit to the accounting system. Laura then divides the mail and takes any bills that are received to Hannah. Hannah enters the bills into the computer and prints the checks. And then she takes the bill payment checks to Emily to be signed and mailed. After looking at the flow of responsibilities at the pet store, can you see how internal controls have separated the jobs so that there's always more than one person who views the cash information? This helps keep that theft and fraud at bay and protects the cash asset. Cash is the most vulnerable asset that a company has. Because of this, there must be a system of cash control within the organization. The best way to control cash is to establish a set of internal controls. Internal controls are rules and regulations that are put into place to guard assets owned by a person or a company. Cash must be protected at both receipt and disbursement. Cash receipts are money received from consumers from the sale of goods or services. Cash disbursements are monies paid out to individuals for the purchase of items that are needed and used by a company. The most effective way to protect cash at both receipt and disbursement is to have both written protocol on cash handling and separation of duties. Separation of duties means to separate one big job into several smaller jobs with a different individual performing each. Whether cash is being taken in or paid out, having several people play individual roles in the handling process will allow for a system of checks and balances where mistakes or fraudulent activity have a higher chance of being noticed.